This week in gold was a clean climb with one sharp exhale. Monday opened firm and extended October's strength. By Tuesday and Wednesday, a softer US dollar and steady safe haven bid pushed spot through the low 4,200s. On Thursday, momentum peaked with a fresh all-time high of above $4,370 an ounce. Into Friday, we saw a fresh breath out. The dollar steadied, trade rhetoric cooled a notch, and profit-taking clipped roughly 1% off the top. Even with that late fade, the week still finished solidly higher than last Friday, and the larger uptrend stayed overall intact. In Australian dollars, the move looked even bigger because the Australian dollar dipped mid-week. The local gold price stretched above $6,650 per ounce in Australian dollars Thursday before easing into the 6,500s by the close. That currency effect does matter, regardless of what currency you're trading gold in. But for Australia, when the Australian dollar weakens against the US dollar, every global uptick in gold lands harder here or wherever you are, depending on your currency, which is exactly what played out for us here in Australia. Physical demand helped keep the floor in place. In India's festive season, buyers shifted towards coins and small bars. Same gold, lower making charges, while foot traffic stayed strong despite sticker shock. In China, retail interest remained active, with local market dynamics flickering between small discounts and modest premiums as price volatility picked up. None of that looked like demand disappearing. It looked like the households adjusting the size of what they buy. Netted out, the snapshot is simple. New records midweek, a tidy shakeout into Friday, stronger weekly closes in both US dollars and Australian dollar terms for us here, and a market that continues to climb the wall of worry, the economic hedge, so to say. Think of the US dollar, I'm going to talk about the US dollar index. Think of the US dollar index as like a scoreboard for the US dollar. It compares the US dollar to the basket of major currencies, mainly the euro plus the yen and the pound. So when the index does go up, the dollar is broadly speaking stronger. And when it goes down, the dollar is broadly speaking weaker. So as you know, gold is priced in US dollars on most global screens. That means a stronger dollar usually makes each ounce feel more expensive to buyers using other currencies. This can cool demand at the margin, while a softer dollar does the opposite and gives gold a tailwind. It's not a perfect seesaw, but it's a reliable pressure gauge. Like anything in trading and investing. Take it with a grain of salt. Here's the practical chain. If the dollar firms, foreign buyers need more of their local money to buy the same ounce of gold. So some step back or buy even smaller sizes. Large traders and algorithms also watch the dollar index in real time and will trim or add gold positions based on its direction. Flip it around, when the dollar eases, you often see bids creep into gold as global purchasing power improves. One important nuance for Australians, since I'm based in Australia, the dollar index doesn't include the Australian dollar at all. I know, terrible. The local price is basically the global USD gold price multiplied by the USD AED exchange rate. So even if gold in US dollars is flat, a weaker Australian dollar can push the local gold price higher, and stronger if the Australian dollar can mute a global rally. That's why you sometimes see headlines saying gold was steady in New York, while the Australian dollar gold jumped or slipped meaningfully, or for any other country. As you'll see me talk about in other videos, regardless of any country, that's why I often report gold prices in different currencies. So overall, keep an eye on the US dollar index for global pulse, and if you're in Australia, the Australian US dollar for the local effect, because together they explain a lot of the day-to-day push and pull in gold. Let's connect gold to interest rates. There are two pieces. There's nominal yields and there's real yields. I have made a video about this, but nominal yields are the headline rates. I have to pause that. A giant fly. I'm in Australia, so a giant fly just flew into my face. Anyway, let's connect gold to interest rates. There are two pieces, nominal yields and real yields. Nominal yields are the headline rates you hear about, like the US 10-year Treasury. The real yields try to strip out expected inflation, so they're roughly nominal minus expected inflations. Why does this matter? Well, when real yields rise, the return you can earn on safe bonds after inflation looks a lot better. So the so-called opportunity cost of holding gold, an asset which doesn't, of course, pay any interest, goes up. And gold often cools when your real yields fall. That pressure eases and gold breathes easier. This week followed that script. Early on, yields softened and real yields edged lower, and gold pushed higher. Midweek, the drift continues, helping carry prices to fresh peaks. Into Friday, nominal yields ticked back up, while inflation's expectations didn't move as much. So real yields firmed and gold gave back a slice. None of these moves were dramatic by themselves, but together they acted like a dimmer switch. Slightly lower real yields brightened gold, and slightly higher real yields turned it down. From an Australian perspective, if you're here in Australia, keep an eye on two tracks. One is the global US real yields, because they set the tone. That's the world's benchmark, of course, because the global reserve currency, US dollar, etc., as you probably know. Track 2, if you're in Australia, the local Australian-based gold price, because it does react to the exchange rate, and the exchange rate can be nudged by the Reserve Bank of Australia's expectations and Australian bond yields. If you're not in Australia, just think of what country you're from and apply this there. That works too as well. Of course, that's why you can see days, that's why you can see days where the US real yields soften and gold and USD jumps, while in Australia the strength partially offsets the move for local holders. Or the reverse is true if the Australian dollar weakens, or whatever currency you're trading in. So overall, gold's day-to-day rhythm this week made sense once you watched real yields. So keep that dimmer switch in view. So the US data story this week was light on the official releases. The US data story this week was light on the official releases. So traders leaned on real-time stuff, weekly jobless claims, private retail trackers, and the University of Michigan's sentiment survey. The picture was slow but moving. Jobless claims stayed in a tight range, telling US layoffs remain low, even as hiring cools. Retail looked modest, ex-auto spending kept inching forward, but once you adjust for inflation, the gain was only a touch. So it's important to understand how much inflation is going on. The sentiment read was basically flat, with short-term inflation expectations easing a hair and long-run expectations steady, which signals that households still worry about prices but aren't seeing a fresh shock. Why does this matter for gold is quite straightforward, really. Early in the week, that softer gross pulse lined up with a slightly easier US dollar and nudged real yields lower, which helped gold grind higher. Later in the week, as traders rotated back to wait and see ahead of the next round of inflation data, nominal yields firmed a bit and the dollar steadied, and gold gave back a slice. Nothing in the data screamed trend change. It was more like gentle pressure on the pedal rather than a massive lift. If you're in Australia, the takeaway is double-barreled, because first, the global pulse comes from US numbers, because they steer the dollar and real yields, the two biggest day-to-day levers on gold. Secondly, our gold price gets multiplied by AUD-USD exchange rate. That's why even if the US does go sideways on a given day, US dollar does go sideways on a given day, a dip in the Australian dollar can still push gold higher and bounce gold if the Australian dollar can blunt a global rally. A bounce in the Australian dollar can blunt a global rally. This is why sometimes as a side note, this is why you'll see like currency hedging if you ever buy a fixed income ETF where they're buying foreign government bonds or whatever, or any other ETF, you might see this. Anyway, to China. China set the tone for physical demand this week after the early October holiday lull. Dealers moved back into restock mode, and the Shanghai market held together, with spot trading either at small premiums to London or near flat. Nothing frothy, but firm enough to keep the metal flowing. That premium matters because it's the on-the-ground signal of real buying when it's positive. Imports make sense, and the bars move from west to east. When it slips, wholesalers lean more on scrap and wait for better prices. Households kept adapting to high price levels. Jewelers reported steady foot traffic, but a tilt towards lower pieces and same gold, lower total ticket. A softer yuan at points in the week lifted at the local price in renminbi. So shoppers were more price sensitive on weight, but not walking away. E-commerce channels and chain stores continue to do the simple things well: smaller denominations, cleaner pricing, and quick delivery, which helps when volatility makes people hesitate. Behind the counter, the usual plumbing did its job. Import quotas and paperwork came through in workable amounts. Enough to avoid a squeeze, but not so to lose the premiums vanished. Refiners matched flows to demand, and wholesalers kept an eye on jewellery scrap coming back as customers traded old pieces for new. None of this screamed boom or bust. It read more just like a market clearing at high prices with buyers trimming size, not disappearing. For Australians looking at this, the link is straightforward. When China's physical bid is healthy, Asia tends to pull metal east, regional premiums firm, and that underpins the global price we all see on the screen. This week's read was steady rather than spectacular. The steady is all gold needs when the broader trend is up. India's gold market moved from stocking up to shopping as the Diwali window opened. Early in the week, wholesalers and large retailers topped up inventories, and local market quotas flipped to small, steady premiums over the official domestic price, just enough to keep bars flowing. By midweek, the rupee gold near the record territory households adjusted in a familiar way. Fewer heavy necklaces and more coins, small bars, lighter pieces that keep the out-of-the-door bill manageable while still tickling the auspicious purchase box. Jewelers did their part to keep the tills ringing, making charge discounts, reappearing on staple designs, old gold for new. Exchange counters were busy, and stores extended hours heading into the festival weekend. Urban demand was the backbone. Metros saw brisk footfall, while semi-urban shops leaned on coins and low-weight bangles to meet tighter budgets. Wedding buyers didn't vanish either. They simply trimmed gram weights and focused on simpler carry-gary to reduce labour costs. I think it's pronounced carry-gary, I'm not sure. Through Thursday into Friday, the market balanced two forces. Sticker shock from high prices and the cultural tailwind that, I don't know how to pronounce this, Dhanteras brings every year. The result was smaller average weights, but healthy transaction counts, which is exactly how India's demand usually adapts at elevated price levels. For investors, 99% pure coins were the go-to for gifting. Silver items stayed in play as a lower ticket alternative, which isn't surprising for anyone who understands how this works. The Australians watching the global pulse, the key takeaway is India's festival bid was present, supportive, even at high prices, which is good. The Indian buyers keep paying small premiums and retailers keep restocking. It helps anchor the broader market and smooth out some of gold's week-to-week swings. In Europe and the UK, they were steady hands this week. Nothing dramatic, but enough to matter. On the policy front, the European Central Bank kept a cautious tone while growth signals stayed soft, and core services inflation remained sticky, which translated to a hold steady and watch the data mindset rather than a fresh pivot. In the UK, the Bank of England's messaging was similar. Tight labour conditions are easing, headline inflation is cooler than earlier in the year, but they're not declaring victory, so markets treated rate cuts as a later data-dependent discussion. That backdrop helped keep a floor under gold by capping how far real yields could rise. Currencies did the quiet work. When the euro firmed against the US dollar at points in the week, it took a little pressure off dollar strength, which is mildly helpful for gold globally. Sterling had its own swings in the UK data and Bureau of Economics chatter. That flowed into the local gold price in pounds, which often moves differently from the US chart you see on most screens. For European investors, gold is still a portfolio shock absorber, and the currency moves are a big reason it still keeps that role. ETF flows across Europe remained two-way but orderly. Early bids tended to come on softer dollar days, while small outflows showed up when the yields ticked higher and risk appetite improved. Retail demand leaned towards coins and small bars rather than heavy jewellery, reflecting the same smaller ticket, same metal pattern we're seeing in Asia, which I just discussed. For Australians watching these overnight sessions, the read-through is quite simple. A steady ECB and BOE tone plus currency moves in the euro and pound shaped the global dollar story, and that helped explain why gold held firm even when intraday headlines looked a bit messy. This is exactly what you want from a hedge. Australia's gold miners live on a simple mathematics. Most costs are in Australian dollars, and most revenue is tied to US dollars. So if you think about it, when the Australian dollar weakens, each ounce sold in US dollars converts into more Australian dollars, which can lift margins even if the global price is flat. So if you flip this around though, when the Australian dollar strengthens, that currency tailwind fades. The margins can feel much tighter unless the US dollar price also rises. This week, the exchange rate leaned in miners' favour for most sessions, so the local gold price stayed elevated and the revenue lines looked healthy on paper. On the cost side, the usual suspects mattered. Labour and contractor rates are still sticky after post-pandemic surge. Diesel and power costs ease from their peaks but remain higher than a few years ago. And any jump in energy filters through to drilling, hauling and processing. Consumables like grinding media and cyanide are mostly priced in Australian dollars with global inputs behind them, so currency and freight still play a role. The result is that an all-in sustaining costs keep the lights on measure that includes sustaining capex haven't fallen as fast as investors might hope, even with better productivity at a few sites. Grade and discipline and dilution control were the quiet winners. Operations that kept all grades close to plan and maintained steady mill throughout saw better cost per ounce, where sites battling lower grades or longer hauls felt the squeeze. Hedging was a mixed bag. Some producers locked in portions of output earlier at lower prices, smoothing cash flow but giving up some upside. Others stayed more unhedged and fully captured the strong Australian dollar gold price. Net of it all, a softer Australian dollar against a firm global gold supported revenue more than enough to offset sticky costs for the better run operations, leaving the sector's weekly read broadly positive. Geopolitics added background noise rather than a blaring siren this week. Early on, headlines were mixed. Cautious language around US-China trade and tech kept the door open to dialogue, while occasional South China Sea and Taiwan mentions reminded everyone that tensions never fully leave the stage. In Europe's east, the Russia-Ukraine conflict stayed in its grinding attritional phase, enough to sustain a general risk premium, but without a single headline that overwhelmed the markets. In the Middle East, brief flare-ups and security advisories nudged energy traders to stay alert, yet oil's intraday swings were driven more by positioning than a clear, lasting shock. For gold, that blend mattered in a familiar way. When geopolitical tone softens, some safe haven bids step aside and you see prices drift with the dollar and real yields. When tone hardens, even for the afternoon, gold catches a reflex bid as traders hedge that tail risk. That's essentially what played out. A few risk-off bursts that added lift to an already firm trend, followed by calmer news flow that handed the steering wheel back to the macro. Currently, channels carried the signal globally. A steadier US dollar into late week limited how much geopolitics alone could push gold, while pockets of euro and sterling strength briefly eased dollar pressure and helped bullion hold its ground. In Asia, steady physical buying meant geopolitical blips didn't have to do all the heavy lifting. They simply reinforced an existing floor. From an Australian vantage point, the takeaway is simple. Geopolitics provided short supportive gusts rather than a new weather system. And the Australian dollar, soft at times, those gusts translated cleanly into the local price. So let's clean up 3 common gold myths. Myth number 1, gold always moves opposite the US dollar. The fact is, the dollar is a headwind or a tailwind, not a remote control. A stronger dollar can cool gold because it makes ounces pricier for non-US buyers, but positioning, real yields, and risk mood can override that on any given day. For Australians, there's an extra twist. Our local price equals global gold in US dollars multiplied by the Australian USD exchange rate, the USD Australian exchange rate. So if the Australian dollar ever weakens, the Australian dollar gold can rise even when the US dollar gold is flat. Myth number 2, rate cuts automatically launch gold. Well, we saw this in the charts a few weeks ago, but the fact is, gold cares about real yields, interest rates minus expected inflation. If central banks cut because growth is cooling and inflation expectations don't fall as much, real yields can drop and gold can lift. But if markets already priced in the cut, it's very important, if they've already priced in the cut, or the dollar firms at the same time, gold may stall. And the why behind a cut matters more than the headline rate move. Myth number 3. Gold only works when inflation is high. Fact. Gold often protects against unexpected inflation and financial stress, not just big CPI prints. It can rise in disinflationary periods if real yields fall. Currencies wobble, more investors want a diversifier that isn't tied to corporate earnings. Over longer horizons, its job is a portfolio insurance. It tends to zig when risk assets zag. It is useful when inflation is calm. The takeaway is very simple. Watch the drivers. The dollar is the pressure gauge, the real yields is the dimmer switch, and the local currency if you're in Australia or any other country. Because those three explain most of gold's why without needing any myths at all. Now, here's another one. Is it too late to buy at record highs? Some of you may be asking this, and it's a very reasonable question. The answer is, well, look, it depends on your time frame and really your nerves, if anything. If you're long-term, price levels matter less than having a plan you can stick to. A simple approach is to stagger entries instead of going in all one day. You've probably heard this before, the dollar cost averaging. I'm sure many of you watching this do this. So I'm sure many of you just have a whole bunch of metals stacked at home, which is awesome. But for Australians, remember the local price also moves with the US dollar, as I've mentioned many times in the video. So timing also can be a bit different depending on the US charts. Now, let's get to silver. Why is silver lagging? Silver kind of has a split personality. It's part precious metal, right? Like gold is, but then it's also part industrial metal. So when growth jitters rise, the industrial side can weigh in on it. So it often lags on the way up and moves more violently in both directions. It can play catch up in bursts, but the ride is bumpier than gold. So coins, ETFs, or miners, what's the difference? Coins and small bars give you direct ownership but include premiums and storage. ETFs are simple and liquid with small ongoing fees. Miners are businesses. They can amplify gold's move, but you can take on costs, grades, and manageable execution. So pick a tool that matches the job you want done, but none of this is financial advice. Does the dollar index cause gold to move? Well, think of the DXY as a pressure gauge, not a remote control. A stronger dollar can cool gold and a softer dollar can help it, but real yields, positioning, and headlines also matter. In Australia, add AUD/USD to that watch list because it shapes our local price. I know I've been going a lot about this, but it's quite important for investors to know this. I think it's something that a lot of people talk about, the currency hedging and all that, but the currency conversions. But another question you might ask is, should I wait for the next big data print? Events like the CPI can create sharp temporary swings, as we've seen on the charts. If you trade those, which I have done that, define levels and risk before the number. If you're investing, the event noise matters less than your horizon, sizing, and why you even hold gold at all, which I understand people watching this, we all love gold and want to hold it, so there shouldn't be an issue there. It's not like I'm exactly making this video convincing you how amazing gold is. I'm sure you already know how amazing gold is, because gold is amazing. That's this week's sort of overall news. Here's what I would recommend watching just for the week ahead, if you're still even this far in the video. Early in the week, keep an eye on China's loan rate setting and any guidance from Beijing. When funding costs ease or tighten, it ripples through growth expectations. The yuan, and often the global dollar tone that feeds straight into gold. Around midweek, the global flash PMIs for manufacturing and services usually hit for the US, Eurozone, and the UK. If they come in soft, you tend to see real yields ease and gold finds a bid, while upside surprises can nudge yields higher and cool the metal. All week long, watch the US dollar index on screen, and if you're in Australia, watch the Australian dollar, as I was saying many times in this video. If you're in any other country you're in, watch that, local currency. A softer US dollar is normally a tailwind for US dollars, and a softer Australian dollar or whatever local currency you're in can amplify the move for local holders, even if the global chart is flat. In the same vein, US Treasury auctions and central bank speeches matter more than the headlines suggest. If demand at the auctions is weak or policymakers sound more hawkish, yields can jump intraday and gold can wobble. Late week, the regular US data pulse, jobless claims, goods orders, housing reads, can set the tone into Friday. Claims that creep higher and orders that cool are the kind of slowdown combo that often supports gold. Opposite can hand momentum back to yields and the dollar. In Europe and the UK, any hints that the ECB or the BOE about timing or future cuts will flow into the euro and the pound, and by extension, the dollar index, which I spoke about earlier in the video, the DXY. On the physical side, keep watching premiums in China and India and the ongoing festive buying in South Asia. Firm local premiums signal real demand and help underpin the international price. Put simply, track PMIs, policy, chatter, yields, and local premiums, because these four levers explain most of next week's push and pull that we're going to see. So here's the risk checklist. All the things that can flip today's script fast. First, real yields. Hotter than expected inflation print or a hawkish tone from a major central bank can push real guidance. Can pull real yields down and lift the model. Secondly, a broader dollar spike, whether from a strong US data or a risk-off shock that funnels money into the US dollar, can pressure on gold in US terms. A weaker dollar typically eases that pressure. I know I've said this a lot, but it is really important to talk about the US dollar. Liquidity and positioning matter more than headlines. If futures positioning is crowded on one side, small news can trigger a fast mechanical unwind. Sharp drops on the way down and air pocket rallies on the way up. Watch exchange margin changes. Large treasury auctions, tighter liquidity, or poor auction can send yields jumping intraday and jolt gold. Risk appetite is another toggle. A powerful equity rally can siphon flows away from hedges, while a sudden equity wobble can make gold catch a bid even without fresh news. On the physical side, premiums are a tell. If China or India premiums fade towards discounts, it hints at a weaker on-the-ground demand, and rallies can stall. Firm or rising premiums suggest real buyers are still there to absorb dips. After festival surges, a normal pause in India can feel like demand weakness on screens, and so context matters, of course. ETF flows sit in the background but can snowball. Steady outflows weigh on price. Steady inflows reinforce floors. For Australians, add the currency risk, a jump in the Australian dollar, or stronger local data, or there's a moth coming in my face. While a softer AUD can amplify US gold moves. Keep these switches in view, and you won't be surprised by how quickly the tone can change. So here's a quick recap. Gold climbed most of the week, hit fresh records near 4,370, then cooled into Friday as the dollar steadied and profit-taking kicked in. The Australian dollar move looked larger because the Australian dollar softened midweek, lifting local price even when the US gold paused. The dollar index worked like a pressure gauge. Softer early helped the rally. Firmer late took a little air out. Real yields acted like a dimmer switch. Easing supported the push up. Late week, firming trimmed the top. On the ground, Asia kept the floor sturdy. China's premiums were steady enough to keep metal moving, while India's Diwali demand shifted to coins, small bars, and lighter jewelry, keeping transaction healthy at high prices. In Europe and the UK, policy signals were cautious rather than dramatic, and currency swings in the euro and the pound quietly shaped the global dollar tone. At home, miners benefited from a strong AUD gold, and a softer currency through sticky costs, and reminded everyone execution still matters. Geopolitics stayed background noise, supportive gusts, but not a new weather system. So if this breakdown helped, please feel free to subscribe to the channel for latest news. Not financial advice, and thank you for watching.